All right, so what do you think about what JP Morgan's saying? Kind of a narrow trade there, big tech, gold, currencies, with the exception of the U.S. dollar.
Yeah, that makes total sense to me. We're long gold as well for clients because we got to remember the U.S. was the first economy to raise interest rates. Now we're coming to the end of our rate cycle. Other economies around the world are going to be continuing to raise rates. That's going to put downward pressure on the dollar and upward pressure on commodities like gold.
All right, so you're saying we're at the end of the rate cycle. So you think this was the final hike? When do you see cuts potentially coming? Is it possible for later this year? Because in all fairness, Jay Powell was a little ambiguous about when that could possibly happen.
It's definitely a battle between what the yield curve is saying and what Jay Powell is saying. My money's on Jay Powell, that he's ultimately going to lead. Unless there's some big economic dislocation with broad ramifications for demand, then I see that they're going to keep interest rates higher for longer. That certainly was what I heard at the Milken Institute, which I just got back from. That was a recurring theme through many of the sessions that I participated in.
Yeah, no, you just got back from there.
Yeah.
You actually were there, and you said AI was one of the big themes there. That's a disruptor. We're seeing the banking crisis. That's a disruptor to the market. So right now, what are you looking at when it comes to investments, portfolio management? Where are you putting money to work?
Well, I want to buy companies that don't need banks to grow their business or sustain their business, that don't need to access either the capital markets or banks. We have a strategy that focuses on concentrated holdings around compounders of return. My partner, Will Potter, and I run a 20 to 30 stock portfolio where we find companies that have big returns in terms of return on equity, return on invested capital, high free cash flow, and have a long track record of effective capital deployment.
Let's get granular, though. We have your picks right here. We're not just talking generalities. We have ticker AME, Ametek, Fortive, and Roper. So what's the one thing that all three of these have in common that makes you confident today to put money into these names?
Each of these companies generates over 100% free cash flow to net income. They've had a long track record of effectively deploying that excess free cash flow. And if they did nothing this year, they'd be completely debt-free on a net basis.
And you're saying you're really trying to avoid stocks that rely on, loans and have a lot of debt because of the rising cost of capital?
Yes. And I also think the acquisition market for these companies, they've been waiting for an environment where acquisition prices could come down. Public valuations are coming down. There's a delayed effect on private valuations, too. But in many of the sessions that I heard at the Milken Conference, it'd be very expensive for private equity to compete for private assets simply because the cost of capital is so high now.
Yeah.